The most urgent warning in global finance right now comes not from a bearish analyst or a political opponent, but from Ray Dalio, the founder of Bridgewater Associates, who has spent more than 50 years studying the rise and fall of empires and the mechanics of debt cycles, and his message is stark: without a fundamental change in course, the United States faces a sovereign debt crisis within approximately 3 years, give or take 2, and the only reliable hedge against the erosion of wealth that will follow is a significant allocation to gold. In a LinkedIn post published on August 21, 2026, Dalio wrote with characteristic conviction that I am confident that the government's financial condition is at an inflection point, warning that if this is not dealt with now, the debts will build up to levels where they can't be managed without great trauma. This is not a prediction of a distant future. It is a calculation based on the mechanical logic of the long-term debt cycle, a framework Dalio has articulated in his book, How Countries Go Broke, The Big Cycle. And the machine is showing us that the arithmetic is as unforgiving as it is simple. The United States is spending approximately $7.5 trillion annually while generating only about $5 trillion in revenue, leaving a staggering $2 trillion shortfall that must be financed entirely through borrowing. The interest cost alone will be around $1 trillion this year, and approximately $10 trillion of debt needs to be refinanced. When the cost of servicing debt reaches this scale, the machine begins to operate in reverse. Higher deficits require more borrowing, which pushes yields higher, which increases interest costs, which widens the deficit further, creating a self-reinforcing feedback loop that can only be broken through extraordinary measures or extraordinary pain. The trajectory of the national debt provides the quantitative foundation for Dalio's warning, and the numbers have crossed thresholds that would have been unthinkable just a few years ago. The U.S. national debt officially topped $40 trillion in August 2026, arriving months earlier than the Congressional Budget Office had projected. The debt-to-GDP ratio now stands at 122%, the highest since the aftermath of World War II. And the CBO now projects that public debt as a share of the economy will reach 120% over the next decade. The deficit for fiscal year 2026 is projected at $2.1 trillion, up from the $1.9 trillion forecast in February. The federal government is now spending more than $3 billion per day on interest payments alone, and those payments have grown 14% year over year. This is not a problem that can be solved through minor adjustments. It is a structural crisis that requires a fundamental rethinking of the relationship between the state, the bond market, and the currency. As Dalio has noted, if the U.S. government were a business, debt service payments would come in at roughly $11 trillion, about 200% of annual revenue. This is not a sustainable trajectory, and the machine is signaling that the adjustment, when it comes, will be painful. The CBO projects that net federal interest payments will exceed $1 trillion in 2026 and approach $1 trillion by 2036, rising from 3% to 6% of GDP. Interest payments have already surpassed defense spending, and the U.S. will spend $16 trillion on interest over the next decade. The transmission to household finances is direct. Heavy government borrowing redirects capital from private markets, driving up rates on mortgages, auto loans, and credit cards. The Conference Board warns that if left unchecked, the current fiscal trajectory would push mortgage costs $53,000 higher for a family buying a $600,000 home by 2031. This is not an abstract fiscal problem. It is a crisis that will be felt in the daily lives of ordinary citizens. The bond market has already begun to impose its discipline, and the Treasury Department's recent intervention provides a vivid illustration of the limits of government power in the face of market forces. On August 19, 2026, Treasury Secretary Scott Bessent announced an expansion of the government's bond buyback program, doubling purchases of 10 to 30-year treasuries to at least $4 billion per operation. The move was intended to calm the bond market and signal that the government was prepared to support long-term yields. The initial reaction was positive. The 30-year yield fell from 337% to 187%. But the relief lasted less than a day. By the following session, the 30-year yield had climbed back above 25%, and the 10-year yield had risen to 7%. The market had effectively rejected the intervention. As Dalio observed, the Treasury has only limited capacity to buy back bonds, and the buyback announcement fits into a larger pattern that can signal a forthcoming crisis. The pattern is clear. Rising debt service costs eventually collide with insufficient investor demand, forcing governments to accept higher interest rates or central banks to print money to buy debt, weakening currencies and fueling inflation along the way. The surge in long-term yields. The 30-year reached 5.33% on Tuesday, its highest level since 2007, is not a random fluctuation but a signal that the bond market is losing confidence in the government's ability to manage its fiscal affairs. Dalio's warning is not a prediction of doom, but a recognition that the pattern is unfolding with mechanical precision. The solution Dalio proposes is straightforward but politically difficult. Reduce the budget deficit to 3% of GDP from the current level of about 6% through a combination of spending cuts, higher tax revenue, and lower interest rates. But he is realistic about the prospects for such reforms. Dalio has noted that there is very little ability to cut spending given that it is either committed or considered essential. The math is unforgiving. Revenue of $5 trillion against outlays of $7.5 trillion leaves a deficit equal to roughly 7% of GDP. Closing this gap would require either massive spending cuts that would affect every major program or tax increases that would slow economic growth. The political system, as Dalio has observed, is not designed to make these choices, and the consequence is that the adjustment will be forced by the market rather than chosen by policymakers. This is the essence of the debt cycle. When governments cannot or will not make the necessary adjustments, the market imposes them through higher yields, currency depreciation, and ultimately crisis. Dalio has warned that similar fiscal strains are confronting countries including the UK, China, and Japan, suggesting that this is not an American problem but a global problem that will reshape the international monetary system. That is why I expect non-government produced monies like gold and Bitcoin to do relatively well, he wrote. In this environment, Dalio's recommendation for investors is clear and emphatic. Reduce bond holdings and put about 10 to 15% of a portfolio in gold, with a small allocation to Bitcoin as a hedge against government credit risk. The reasoning is rooted in the mechanics of the debt cycle. When governments are forced to print money to finance their deficits, the purchasing power of fiat currencies declines, and assets that are not government issued or government backed tend to perform well. Gold, which has no counterparty risk and cannot be printed at will, is the classic hedge against currency debasement. Dalio describes gold as a non-liability asset, distinct from a bond, which represents someone else's promise to pay. Central banks have been adding to their gold reserves in recent years, a trend that picked up alongside geopolitical tensions and growing skepticism about the dollar's long-term dominance in global trade. Gold has overtaken U.S. Treasuries and global central bank reserves, and the metal has climbed more than 30% over the past 12 months. Dalio's 10 to 15% gold allocation marks a sharp break from typical institutional portfolios, where gold usually sits at 2 to 5% at most. He isn't calling for an all-in bet on bullion. Instead, he wants the conventional 60-40 stock-bond split, updated for a period of fiscal deterioration. The historical parallel that Dalio has drawn is the 1970s, a period when inflation and rising debt pushed investors out of fixed income assets and into gold. Speaking at the Greenwich Economic Forum in October 2025, Dalio told his audience that when you're doing your asset allocation, what is going to protect your real after-tax returns? So you do create that optimal mixed golds is a very excellent diversifier of the portfolio. He added that if you were to look just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold, because it is the one asset that does very well when the typical parts of your portfolio go down. Because the typical parts of your portfolio are so credit dependent. The logic is impeccable. When the financial system is built on credit and debt, The assets that are most vulnerable are those that depend on the continued functioning of that credit system. Gold, by contrast, is not anyone's liability, and it thrives precisely when the credit system is under stress. Dalio's recommendation is not a speculative bet, but a strategic allocation designed to reduce risk in a portfolio that would otherwise be exposed to the erosion of the dollar's purchasing power. The market has already begun to validate this thesis. Gold jumped to the highest since May on the day of Dalio's post, while Bitcoin topped $77,000, heading for its biggest weekly rally since 2023. The inclusion of Bitcoin in Dalio's recommendation is notable but carefully circumscribed. He has suggested holding a small portion in Bitcoin, acknowledging its risks but valuing its diversification benefits. Dalio has expressed a preference for physical gold over digital assets due to regulatory and technological risks, describing gold as a reliable hard currency. He has stated that Bitcoin is not as good as real gold, and his recommendation for Bitcoin is far more modest than his allocation for gold. He suggests that capitalists will be the biggest beneficiaries of the AI transformation, but human emotions and intuition remain irreplaceable. The distinction is important. Gold is the primary hedge, the foundation of the portfolio's defense against currency debasement and sovereign risk. Bitcoin is a complementary asset, a smaller bet on the same underlying thesis that an asset outside government control can provide diversification benefits. Dalio's stance reflects a cautious shift among institutional investors toward hard assets amid economic uncertainty, and his recommendation is grounded in decades of observation and experience rather than speculative enthusiasm. The final principle, and the one that Dalio has articulated through decades of observing these cycles, is that the debt crisis is not a risk to be feared, but a transition to be navigated. And the investor who can navigate this transition will be the one who builds lasting wealth. The $40 trillion debt milestone, the $1 trillion interest expense, the surge in long-term yields, the retreat of foreign buyers, and the Treasury's failed intervention are all signals from the same machine, telling us that the United States is on a collision course with its own fiscal reality. Dalio's warning is not a prediction of doom, but a call to action. A recognition that the choices made in the coming years will determine the trajectory of the global financial system for the next decade. The investor who understands these forces can position themselves for the opportunities that the crisis will create, while the investor who assumes that the old relationships will return will be left behind. The machine will continue to operate according to its timeless principles, and the investor who respects those principles, who maintains discipline, who stays diversified, who keeps dry powder for opportunities, will be rewarded. The question is not whether the crisis will come, but whether you are prepared. The arithmetic is unforgiving. The pattern is clear, and the time to act is now.